And looks like we are live. So, hey everyone. Well, hold on a second. I think I have to, give me 1 second. I think I have to type in a title. Say something about this video. Yes. Mortgages, money. Okay, give me a second, everybody.
Are we broadcasting?
We are live, but it's asking me to add a title, so I'm just doing that right now so people know what we're talking about. So now I'm going to click go live, but technically even when it's in preview, it's, from what I'm seeing, it's actually live already. Okay, yeah.
Okay.
It should say we're live there. Okay, we're live on Facebook. Hey everyone, Leticia here, coming to you this Thursday afternoon for another edition of my weekly Money Matters webinar series. And as announced yesterday, today's topic is mortgages for the rest of us. And you'll understand soon enough what that means. And I have the pleasure of having as our guest today my business contact and friend, Mr. David Grossman. I know David from the business community because he is very active in the local real estate investing community in the Toronto area and beyond. He used to run a popular weekly real estate investing related meetup where I even had the pleasure of speaking at. Thank you, David, for that opportunity. And David is just an overall great guy. And in addition to that, he's a very experienced mortgage broker, 17 years of experience in the as a mortgage broker. And the majority of that time has been spent helping people who are not getting what they want from the bank. Because as I explained in my little introductory video yesterday, the first time people buy a home, first of all, they make the mistake of talking to a realtor first, when they first should be talking to a mortgage broker. Maybe David will talk about that a little bit. But the first thing they do is, once they talk to the realtor, they'll go to their bank. And when you go to the bank will show you their suite of products, and that's all you're getting. And David will explain to you what the differences are between, you just going to the bank, especially for those of us who are self-employed business owners, or those of us or those of you who are looking to grow a real estate portfolio. Just walking to the bank and talking to a teller at the bank, that's not going to give you the best results more often than not. And you could, in fact, be shooting yourself in the foot for the long run. So with that long introduction, thanks, David, for joining us. Welcome.
Thank you, Leticia. Thanks for having me on your podcast. I really appreciate it. It's nice to be included, and very excited to talk to you and your viewers today about alternative mortgage lending, or mortgages for the rest. That's a very good title. Should I expand on that?
Yeah. Any starting words, David, and then I also know you prepared some slides for us. So when you're ready to get started with your slides, let me know, and I'll
Sure.
make you host. Yeah.
Okay. All right. Sure. So, so as you said, Leticia, I've been arranging mortgages now for about 17 years. And shortly after I got into the business, I decided to start focusing on alternative lending, to focus on people who were not getting what they wanted from the bank for whatever reason. And there's a number of reasons why people may not be best served by the bank. Sometimes you may qualify at the bank, but you can sometimes go into a bank and you may be speaking with somebody who 1 minute is dealing with deposits, the next minute they're dealing with investments, and then the next day they're on holiday, and then the day after that they're in a meeting, and before you know it, your 5-day financing condition, if you're buying a property, let's say, is up. And I'll never forget this story that these people came to me once on Thursday, 4 days into a 5-day financing condition. Because when you buy a house, you're under the gun, right? You get an offer accepted, and typically you have 5 days. And today, nowadays, with the crazy market the way it is, more people are going in firm, which means they have to be pre-approved beforehand.
Yeah.
And they have to have a lot of confidence in
Yeah.
that approval, because if they go infirm and they don't get the mortgage eventually, they're going to have problems. So somebody came to me 4 days into a 5-day financing condition, and they told me that exact story, right? They had been pre-approved
Approved,
by
yeah.
the bank, but it would appear that it was by somebody who was not very experienced or didn't ask the right questions. And, the whole week passed. Monday, they were in a meeting. Tuesday, they were homesick. It was always something. So finally, on Thursday afternoon, the bank gets back to them and says, you don't actually qualify. We're sorry. You're actually
Wow.
considered self-employed, right? Because even though the person was on a contract,
Yeah,
the employer was not taking deductions at source.
right. Yeah,
So it was a contract, and there was no
yeah.
guarantee. It was not considered permanent, and no minimum guarantee as to the number of hours. So the bank backed out of the deal. And we were able to get these people financing in 1 day.
Wow.
And yes, they did have to pay a little bit. So I'm still in touch with this person today, because what they did was they actually bought this house and they converted it into a triplex.
Oh, wow.
It was in the Junction area of
Mm-hmm.
Toronto, and
Mm-hmm.
they didn't mind paying a little bit higher mortgage rate, and they were able to still make enough money from two of the units to actually pay the mortgage. So it was turned out to be a great investment for them. So so there's a number of things you need to know when you're being pre-qualified, or when you need your real approval. Like if you have an accepted offer and now you need a real offer of financing to waive your conditions, you want to be dealing with somebody who deals only in mortgages and knows what they're doing, because otherwise you can waste a lot of time and you can get caught short. So
Now, I
that's
had, sorry for interrupting, David, but that's an area that you were just explaining actually brought up a question for me. And perhaps you can expand on this later. But in terms of qualifying, I hear kind of conflicting information as to whether, in the example that you gave, there was rent coming in from the other 2 units of the triplex. Now, was this a legal triplex, or,
Yeah, very,
'cause-
very good question.
Mm,
So if you're dealing with a bank, right, a bank will only consider the income from if you have additional units, if those units are legal units, okay? Meaning
which
it's
means you would have had to get permits and get the property approved by the city as a legal duplex or a legal
exactly.
triplex.
Exactly.
Okay,
But some of the lenders we deal with,
sorry
they
about the
don't, they
helicopter
don't,
sound.
they don't, they don't care if it's legal or if it's not legal. I mean, we would always encourage people to make it illegal. And at a minimum, you want to make sure it's safe, right? Because
Yes,
you don't want, you don't want people being trapped in an unsafe
yeah.
space in case of a fire or what have you.
Mhm.
Um, but the place could be safe and it may be not permitted. But some of the alternative lenders that we deal with, not banks, they're a little bit more flexible than the banks in the way they look at things. They will consider income from a second or a third apartment, as long as the apartment is a self-contained unit with a separate entrance and it's got a kitchen and a bathroom.
That's
Then it's
amazing.
a
Yeah,
self-contained unit that they know that this could be rented out. It
yeah,
can generate income, and they will use that income to help qualifying. So, that's another reason why some people look at alternative lending,
absolutely.
to help qualify for those types of properties as well.
Thank you, David. Thanks for clarifying that, because there are definitely lots of properties in that situation, properties that have been used as a duplex or a triplex for many years, and you may be the new owner buying a property like that, and the expense of making into a legal duplex, so there's a cost associated with that. So that may not be within your budget, at least for the time being, but you're counting on that income to even make the mortgage. So
Yeah.
the fact that you have lenders that are willing to consider that income, that you will very likely be getting, because these are self-contained apartments. And if you,
Right.
if there
I
isn't a mortgage,
once heard that a crazy number, like the percentage of units in like apartment units in Toronto, when people add a second or third unit in their house,
Mhm.
percentage of units that are not considered fully legal in that sense is so unbelievably high, like that it's over 90%. That's what I heard. So again, we encourage people to make it legal. Listen, it's nice if you can qualify at the bank. There's, nothing wrong. And as a mortgage broker, I do work with banks. Okay, and
Of course, you have
I
access to
arrange
all the lenders.
mortgages for
Yeah.
people at the banks. I'm happy to do that. I have no problem. But in terms of where am I going to focus my marketing efforts,
Yeah.
I'm focusing on alternative lending, because there are a lot of opportunities and there's a lot of need in that area. You've mentioned self-employed, property investors. You have people sometimes who have credit issues. You have seniors, right? You have seniors who may have lots of equity in the house, but they don't have the cash flow. So what do? There's mortgage options for people. So as
And I
long
think
as
I'm
it
going to
makes
have you back another day, David, to talk about, for example, the reverse mortgage concept in
well, it's
particular.
part of the presentation, so
Oh, well, aren't you a
maybe we
sweetheart?
should
Okay.
fire up that
Surprise,
presentation now.
surprise.
What do you
Okay,
think?
yes. Okay. That's awesome. That's really great to know. I'm going to make you a host, and then you could, there you go. You should be able to share your slides now.
Okay, so let's try and bring up the slides.
And by the way, for everyone watching, while David is showing his slides, we're not able to see, I'm not able to see the Facebook screen, but please don't be shy. If you have any questions at all, please put them in the comment section, and David will be happy to answer them at the end of our conversation.
For sure, for sure. Okay, so are you able to see the
Yeah,
slides?
yeah.
Okay, very good. All right, so I've kind of divided it, mortgage offers, into basically two categories, right? You have inside the box and you have outside the box. So our focus today is outside the box, right? Mortgages for the rest of us. But without knowing what is inside the box, it's kind of, hard so I'm not going to spend a lot of time talking about what's inside the box, but I'm just going to do, a quick overview. And some people call it A lending, right? It's prime lending. It's bank type of lending. So what is that? That's where you have a down payment, where you can have a down payment as low as 5 or 10% down, right? So if you're buying a property for under $500,000, you can purchase it with as little as 5% down. If it's between 500,000 and $1 million, you pay 5% down minimum on the first 500, and on the next increment, you have to pay at least 10% on that. So that's sort of how it works. And if the purchase price is more than $1 million, it cannot be insured, right? So whenever you have less than 20% down, the mortgage is insured by CMHC or one of these insurers. This insurance that people talk about, it doesn't really help you, the borrower. It helps the lending institution. It covers them in the event of a loss. And the law in Canada is that the mortgage has to be insured if you have less than 20% down, which is good in the sense that it helps make home buying possible for a lot of people, because home prices are so expensive that if you can get in with 5 or 10% down, it certainly does help. Here's the figures that I just mentioned. So the first thing, as I said, down payment. You have to have some down payment. The next thing is credit. What do lenders look for? The banks typically want to see at least a 2-year credit history and at least a couple of trade lines. A trade line is like a credit card or a line of credit or a car loan. I'd say 2 or 3. If you have those running clean for a couple years and you meet all the other criteria, the down payment, and the next one is income that we're going to talk about, then you are you should be able to buy a property. So the next thing after down payment and credit is income, right? So how much income do you need to qualify for a mortgage? Well, as a rule of thumb, I say you take your income and you multiply it by roughly 5 times. Okay, approximately that is how much mortgage you're going to qualify for. So if you make $100,000 a year, then you might qualify for a mortgage of around $500,000. Of course, we have to consider people's debt obligations in that as well. So, you know, I always caution people, don't go out and shoot yourself in the foot by financing or leasing expensive cars, as an example.
That
We
is
see
the
this happen
worst.
sometimes.
Yeah.
The monthly payments are so high. When a
Yeah.
$500 payment on a car is equivalent to $100,000 of a mortgage, roughly. So you really take a bite out of your ability to qualify when you do that. So try and avoid these big car loans and car leases. Um, as far as proving income to the bank, what do they want to see? Well, if you're salary, they want to see a job letter and a pay stub. And if you're self-employed, they will typically want to see 2 years tax returns and 2 years notice of assessment. Now, this
Yeah.
becomes a somewhat problematic for self-employed people, because sometimes self-employed people could be doing very well, but they may be reporting a lot of expenses. And sometimes some people are going to be more creative than others with their expenses. And you know,
Yep.
you take a real estate agent, let's say, who's maybe
Yep.
making $150,000 a year in commission, but
Mm-hmm.
by the time they put in all of their expenses, they might have a net income of $50,000 as
Or
an
less.
example,
I've
or
seen
less.
even, yeah,
Right,
I've
right,
seen very high discrepancies
exactly.
between the
So,
gross and the net. Yeah.
right. So when you go to the bank says, oh, you're self-employed, you're on straight commission, give us 2 years tax returns. They look at the bottom line. Oh, your net income after expenses is $50,000. We're going to qualify you based on $50,000 income. Again, take our rule of thumb, multiply 50,000 by 5 times. What are you going to buy with a $250,000 mortgage? Not
Nothing
very
in the
much.
GTA. Nothing in the
Exactly.
GTA. Maybe Niagara region, perhaps.
That's
If
right. You
if
could.
that. Yeah.
So with some of our alternative lenders, they'll say, you know what? Don't show us tax returns, because we know some people, like, you know, we're not CRA, we're not the government here. We want to know if you can afford to pay the mortgage. You're making $150,000 in commission. We want proof that you made $150,000. We'll assume something reasonable in terms of expenses. What are reasonable expenses if you're making 150? Maybe $30,000. So we're gonna qualify you based on 120, just based on what is reasonable. And now you can qualify for a much bigger mortgage. Again, you do have to pay a little bit higher rate when you're talking about an alternative lender, but it helps you if it helps you get the property that you want, and at the same time you're able to save tens of thousands of dollars on your taxes, you know, to pay an extra point or so on your mortgage is not a big deal, right? Like banks are charging around 2% right now. So with an alternative lender, maybe you pay 3%, but you can also do it on a 30-year amortization instead of 25 to help keep your payments down. And these alternative lenders, some people call them B lenders,
Mm-hmm.
okay?
Mm-hmm.
I don't like to call them B lenders, because it suggests that you are a kind of a substandard client, right? Whereas we
Yeah.
deal with people sometimes who are making very, very good income, but you know, they're aggressive in terms of how they do their taxes. And as a result, the banks don't give them what they want and what they need. Anyway, so I've kind of gone ahead, but let's try and catch up. So last thing on inside the box mortgages is, as I said before, they have to be insured when you have less than 20% down. If anybody is watching and they want to snap a photo of this, they can snap a photo. So the insurance premiums, they're not small, okay, but they're added to the mortgage. So at least if you don't have a ton of cash, it doesn't come out of your closing costs. It's capitalized, added to the mortgage, and doesn't make a huge difference to your ongoing payment. Okay, so that's all I'm going to say about insured mortgages. So now, there is such a thing as outside the box A programs. What could I possibly mean by an outside the box bank or a lending program? What I'm talking about here is bank programs that a lot of people don't know about, and sometimes even the banks don't know about.
Wow.
I'll never forget. I had a time. There was a guy, actually he moved to Canada from South America. He was an executive with a company, and he talked to a bank. I won't say which one. It's a green bank, and and they told him, because he was new to Canada, that he needed like 35% down.
Oh, wow.
I got him approved with the same bank with 10% down, because there are programs for new to Canada
Wow.
that not everybody, again, that's the difference between talking with somebody who's not up on all the programs that are available
That's amazing.
and somebody who specializes this, and that's all they do.
That's
So
amazing.
there are programs for people who are new to Canada. You can, if you're new to Canada, you can get a mortgage with as little as 5% down. Of course, you have to be working. You do not have to be permanent in like a permanent resident. You could be here on a visa. You do have to have
That's amazing.
a credit report from the company, from the country that you came from, either an Equifax or a TransUnion report or something similar, and you can potentially get a mortgage with as little as 5% down. And even if you don't have that, but you have, let's say, 12 months proof of paying various utilities. Let's say you have a cell phone bill or some other kind of bill that you've been paying. You show that, and that will suffice as an alternative for. And we're talking best available bank rates. The other thing a lot of
That's
people aren't aware of,
amazing, David.
yeah,
That's
is
amazing. I
there are.
had no idea. I thought you pretty much had to be a PR to qualify for some of these programs. And I can tell you that I wish one of my new immigrant friends who is in a similar situation, he's waiting for his PR status. He's here on a work visa, and he couldn't, he was told by the bank, and you know what, I actually have to talk to him because I think he just put down a payment on a pre-construction condo, and when it comes time to qualifying, he was very concerned because he was under the impression that he had to come up with the 20. Well, but with pre-construction condos, it works a little different because you do have to come up with pretty much 20% usually by the time.
Well, you have to, yeah, I mean, that's to satisfy the builder. But ultimately, if you're going to qualify with 5 or 10% down, then you're going to get money back at the time of closing, right?
Interesting.
You're
Yeah,
going to
I
get
see.
money back.
Very interesting. So you know what? I'll check with this person to see what situation he's in right now. But he was under the impression that he couldn't even get a mortgage because he wasn't a PR. Like that. That's
Yeah. I just closed the transaction like in the last 1 or 2 weeks with somebody who was here on a work visa. She showed, they wanted to see that she had applied for her PR,
yeah, permanent
which
residency.
yeah,
That's what we're talking about.
permanent residency,
Yeah,
but she did not have her permanent residency as of yet, and there was no problem.
that's
There
amazing.
was no problem. We got her the mortgage, so it can definitely be done. Multiple units, as long as you're living in the property. Okay, you can buy up to 4 units. A lot of people don't know this. So if you want to get into the investing world, again, as long as you're living in the property, with as little as 5% down, you can buy up to 2 units. Now, these have to be legal because it's a bank
Okay.
program, okay?
Okay.
It's a bank program.
Okay.
If you have 20% down, They don't have to be legal because now we can look to some of our other lenders. But as far
Okay.
as or alternative lenders,
Okay.
family plan, you can buy more than one house. Let's say you want to buy a house for a child, like
Mm-hmm.
an adult child, or somebody who's in school, or a parent. As long as you qualify on income, you can buy more than one house with as little as 5% down. That's the family plan. Stated income. There are ways to get around the regular rules because
No
normally you
way. We
have,
still
right?
have
Yeah.
access to that, David?
There's, yeah,
Stated income?
now it has to be reasonable. Okay. So
Yeah.
let's say somebody, their gross revenue is $120,000 a year and they're reporting a net income of 40, but we need 80 to qualify. That might be reasonable. Okay. So that's something we could possibly do. Um, uh, so there are ways to do this with as little as 10% down. Um, New to Canada, we've talked about, and we talked about how you get around the fact that they don't have, 2 years of established credit. We can get around that, as I said. Purchase Plus Improvement is a program where people can buy a house and they can get the lender to agree to advance or to finance certain renovations. And they have to complete the work, but it's all part of the original purchase. So let's say they get quotes to do a kitchen, bathroom, whatever. The lender says, okay, we're going to finance that. They loan you 95%, let's say, of the purchase price on the closing, and then they agree to fund you an additional 95% on your renovation
An
cost
additional
once
5%.
the rentals are right. Once
Yeah.
the rentals are complete. So it's a way to get the renos done immediately after your purchase and finance, which is a great program because some of this, especially if you want to live in the city or somewhere where a lot of the houses are a little bit older and they
Yeah.
might need some work. So that's how you can get things done. Okay, so that's the outside the box bank type of lending. All right, now let's put aside the bank. Now let's say you don't qualify at the bank. The bank's looking at your application and they say, you know what, you don't make enough money to qualify for the loan you want. You may be in a salary job, and especially if you recall a couple years ago, there was a stress test that was
Yeah. Yeah. So is that still going on, David?
yeah, it's still
Okay.
going on. So it means that whatever rate you contract at, you actually have to add at least 2 percentage points to it.
Okay.
And the lender looks at the payment as if it was 2% higher to determine if they're going to lend you the money or not. Okay. But there are lenders who are not federally regulated and provincial, and they don't fall under the stress test. So, and there are
Wow.
lenders, yes, and there are lenders who have expanded debt servicing ratios. I don't want to get into too technical, but the bottom line is that, given your income and given your total debt, they'll say, we're going to allow more debt than a bank would. Again, charge a little bit higher rate, but in some cases, it's significantly more. So, as long as you will be able to make the payments on that mortgage, they will lend you the money. They don't want to lend you the money if you're not going to be able to afford to make the payments. But sometimes people have support from different areas, right? They may have a family member living in the house with them who is working or who has a pension income, let's say parents. And it's like, well, we're not going to put the parents on title. We're not going to ask them to guarantee the loan, but we understand that's the plan. It makes sense, and so we're going to give you the mortgage. So that's a good example of where a minus, right, or a B lender would help. C lending is considered private lending, right? And
Okay.
we arrange that for people sometimes, but private lending is expensive. Okay.
Yeah. Yeah.
And
And I had a
so,
lady, David, I had a guest speak about the world of private lending, more so from the perspective of being a lender of the funds. Um, but sometimes, and maybe you can touch on that, she also explained like cases where a private loan may be necessary, but that is the scenario where a potential buyer or potential borrower doesn't even qualify under the programs that you are going to be primarily talking about, which
Right.
the B lenders or the, well, what
Right.
people alternative lenders.
Yeah. So right, exactly. So sometimes we arrange private loans for people, but here's the thing about private loans. They are expensive, and usually it's
short
short-term
term, yeah,
money. Because if you're going into now, here's one example where you might need a private loan for long term. Let's say you don't you might be self-employed and you're in a purely cash business. You don't
Mhm.
you don't have any income at all. Like you don't report, you don't, then the money's not even hitting your bank statements. Okay?
Yeah,
Okay?
that's very tricky. Yeah,
Right, right.
yeah,
So, that's a case when somebody might need a private mortgage for longer term. And if they're making enough cash and they can pay that, but I would tell those people, look, you're better off depositing some of that money in the bank, so that you can qualify for an institutional mortgage, even if it's not a bank, um, and you pay 3% or 4% rather than 7, 8, 9,
yeah,
or even 10, right? Because private
yeah,
money can be, but most often private money is short term and it's transitional. Like
yeah,
there's an event going on. Maybe you're stuck with two properties, you plan on selling one. Somebody's waiting for a settlement to come in, an insurance settlement to come in. They're planning to sell the house. They're hoping to get re-employed. Somebody lost a job and now or somebody was sick and had to pay expensive money to service some debts, but now they're better and they're ready to go back to work. So there has to be an exit strategy, right? There has to be a
yeah.
way to get out of that private loan, because it's hard to sustain it long term.
And again, if you guys want to know more about the world of private lending and private loans, we had a whole session on that with my guest Susan Flanagan, who is literally, that's all she does. That's her area of expertise. David will access private funds um, as appropriate in those cases where it's called for some of the reasons that he explained.
Right, exactly. So there are cases now. One of the other. Hey
No,
there.
Anthony,
What's your
no.
son's name again?
Anthony,
Hey, Anthony.
Anthony,
How you doing?
Mommy's doing a live webinar right now. Can you
Ha
please,
ha
we'll
ha.
talk a bit later, my love.
Anthony. Hey.
You
Okay.
remember,
Very good.
he's grown so big, eh, David?
Yeah. Yeah. He's a big boy.
David,
Looks happy.
Anthony has come to some of David's live in-person webinar sessions. Okay, my love. Thank you. Okay, my love. Thank you. Okay. Sorry.
I'm gonna hide this.
Okay, please don't. Thank you. Okay. Okay. Thank you.
Okay. So shall we continue?
Yes, please. I
All right.
apologize.
Okay. So the other thing that can happen is people can run into issues with their credit, and banks are very strict on credit, right? The
Would you give
sayings.
us some idea, please? I mean, because people are wondering, I have my credit is 650 or 670 or 640 or, somewhere below 700. Because I've always heard that, yeah, if your credit is 700, you're good to go to the banks. That's usually even to apply for a non-secured line of credit. I hear that's pretty much the minimum banks are looking for. I don't know if things have changed. But could you please comment on that in case people are somewhere in that vicinity and they're wondering, hey, can I even get a mortgage at all?
Sure. Okay. So it's not only about the credit score, but you're right that if you have, like, anything over a 680 is considered very good,
Okay.
right? It's still possible to get a mortgage with a credit score below 680. Sometimes we get people mortgages who have credit scores like way under that. Okay.
Really?
Yeah.
Wow.
Um,
I mean, a
not
private mortgage, I would
not usually with
understand.
the banks,
Mm.
but even the alternative lenders, like, it's more than just about the score. It's about what is going on, really, right? So if you're in the middle of a firestorm, right, and you have lenders chasing you all over the place. Like if we look at your credit report and your credit report shows that, you know, you owe this guy $20,000 and you haven't made a payment in 6 months, and you owe somebody else, you know, $15,000, and, you know, you haven't been making payments. Okay, that's not a time to be applying for a mortgage. Unless you are, let's say, what is possible is that if you can take equity out of a house, you're probably going to be looking at a private loan in this case. Take equity out of a house to pay off the debts. So as long as the loan is going to be to kind of rehabilitate your
Sorry, I think my
situation,
connection is unstable. My love,
then
please. No, not right now,
then
my
it's
love. This is
possible
not
to
a
get
good time. Please,
to
my
arrange a
love.
mortgage for somebody who's like in a kind of a in the middle of a credit disaster. But institutions generally, that, you know, they're going to look at the
Thank you.
big picture, right? So they're going to look like, okay, so if there was an event all apart, like let us or so went, lenders want to know, okay, well, where are we now in relation to that event, right? So if the person had lost a job, but now they're re-employed and they can show that they're making enough money to service the debt, and we can pay off those debts from the proceeds of the loan, then that's, you know, that's okay.
Okay.
Right? That's okay. That'll work.
As
right?
long as there's almost an exit strategy from the bad situation that the person had passed through.
Yeah, lenders don't want to loan and just add fuel to the fire. Like, you know, they want to make sure that the person is on the right track to be able to resolve their issues. You know, a consumer proposal is another one,
Yeah,
right?
what can you tell us about that, David?
So
I just assumed that's a no-go, just like bankruptcy. Look, maybe you could mention a little bit about that. I mean, because
sure.
there are people out there who may have
Yeah.
to that or are maybe
So
considering.
sometimes we work with trustees. Like if somebody has a lot of debt, let's say somebody has $100,000 worth of unsecured debt, and we look at how much equity is in the house, and we say, you know what, we can get you 50,000 out of the house, but we can't get you 100.
Interesting.
So we bring a trustee to the table, and the trustee makes a proposal to the creditors. And he or she says exactly that. Says, look, we can get 50,000 out of the house. So let's make a settlement. We'll take the money out of the house. We'll give you the 50,000. And we expect you to take a bit of a haircut. But, you know, it'll be a
better than nothing for them.
Right. It'll be a one-shot payment, and it'll be a settlement. Sometimes we have people, they come to us, they're in the middle of a proposal.
So
yeah,
let
go
me
ahead.
ask you, so David, just so I understand, so in that case, we're not talking about a consumer proposal, because my understanding of the consumer proposal is that it's a 6-year payout. That's not what we're talking about. You're saying this would be a lump sum. Listen, we're going to be able to extract some equity from the house, pay off some of this consumer debt, but this is done through a trustee, and you're saying it's a one-time settlement.
Okay, so that's a good point. So
I want to understand.
with a consumer proposal, usually it's a certain amount of money. Let's say 30 cents on the dollar is what the creditors are going to expect to get, and usually you can pay that over, let's say, 5 years. So it's divided up over 60 months. Okay, but that's not to say that you couldn't pay the entire proposal off all at once.
I see.
You
And
could
they're
do
probably
that.
happier with that because they can take that money, reinvest, do other things with the money.
Right, right. So So sometimes a loan can be arranged when somebody's entering a proposal and is part of the proposal. And other times we have people come to us and they say, look, we're halfway through a proposal. We have $20,000 worth of payments left. It's another 12 months or 2 years remaining in this proposal. Can you help us take some equity out of the property so that we can pay off this proposal and put it behind us? And the lenders will often, even an institution, will lend, not a bank, but some of the alternative lenders will lend, and as long as they know that, and they'll direct the funds to the trustee in
Wow.
order to settle the remaining debt, so the person can then start to rehabilitate their credit.
That's interesting. And you know what? That's very interesting, David. And perhaps this is a topic where I could have somebody that works in that area as a future guest, because even for me, it's not a world I know a lot about. And yeah, I mean, this brings up some good issues. But I mean, there are people out there who are facing those types of circumstances, and it's good to know that you still have solutions. In other words, mortgage solutions for somebody like that. What about somebody who's passed through bankruptcy? I mean, again, I don't want to, I don't want to burden you, but I'm curious, right? Because
Yeah.
a bankruptcy stays on somebody's record for what, 6, 7 years? How long now?
Yeah, so that's that's really a myth, right? Like, it'll stay on your credit report for a number of years, but it doesn't mean that you can't start borrowing money before. Now, the bankruptcy should be discharged before you start borrowing money again. And a bankruptcy can last either 9 months or it can last 24 months, depending
Oh,
on the type of bankruptcy. Okay. So
okay.
there's, every situation is different, but it can last. So can last either 9 months or 24 months. Basically, they look at how much money you're making every month, and if it exceeds a certain amount, then they're going to keep you in the bankruptcy for 24 months and watch to see how much money you're making. Because if you're making a lot of money, the creditors are going to want a bigger piece, right? But if you're falling below a certain threshold, we okay.
Yeah. It's kind of cutting in and out, but I can hear
Yeah.
you okay, David. Keep going. Yeah,
Okay. So
I see.
but once the bankruptcy is discharged, then what we recommend you do is you can take steps to reestablish your credit. And that's what this tip is here on the slide. You can get a
Mm,
secured credit card from either Home Trust or Meridian Credit Union. Those are two institutions as examples. There may be others. Where you go, you put down some cash, and they hold on to the money, and they give you the credit cards, and then you can start to rebuild your credit score. You can get a mortgage the day after your bankruptcy is discharged.
wow.
It's not going to be at 2%,
No,
okay?
no.
But you can get a mortgage at decent rates from an institution, as long as you will need to have probably at least 25% down.
Okay.
Okay, and you're going to need to show that you have the income that you can support the debt,
The
obviously.
payments. Hmm.
But from a credit perspective, no problem. As long as that bankruptcy is discharged, you can get a mortgage.
Don't get any ideas, guys. Just kidding. Well,
Exactly, but
I mean,
you want to get the
that's good to
secure
know, though.
cards and do this and take the
To
steps,
rebuild your credit.
because
Yeah.
the better your credit, the better rate you're going to get. So you want to take steps, but absolutely, it does not take 6 years or 7 years or whatever it is
That is
before you can
amazing.
get them. The banks want to see 2 years reestablished after discharge of a bankruptcy.
Okay. The
They will
banks.
lend you money,
That's
banks,
the
but
A lenders
that's
again with,
correct. But the
okay.
B lenders, a day after discharge, you're good to go.
This is amazing. This
Yeah,
is, yeah, like that.
yeah.
I bet you a lot of people had no idea that that's the case. And
I'm sure
thank you.
they don't. Yeah.
Thanks for dispelling that myth, because again, a lot of people are thinking, oh, my credit is going to be destroyed for 6, 7 years. Now, but that being said, while the bankruptcy, and I'm not sure if you can comment on that, David, out of curiosity, while the bankruptcy is still on somebody's record, it will show there. But now, once it's discharged, do you now have the ability to rebuild your credits right away?
You, as soon as the bankruptcy is discharged, you can start rebuilding your credit. I mean, you can actually get there's nothing to stop you from getting a secured credit card even before.
Even while you're in the process.
Right. Right. But as far as getting a mortgage, your bankruptcy, at a minimum, it needs to be discharged.
Interesting. No, thank you for making that clear. That's again, that's really good news for a lot of people who maybe thought, oh man, there's no hope for me, or I have to wait a long time.
Exactly.
It's really great.
Exactly. Yeah.
Got it.
Right.
Good. Anything else? Okay, and this is
yeah.
really great. I'm glad you're touching on this.
Yeah.
Awesome.
How are we doing for time? We're okay?
And we'll still have, 15 minutes, David. We're
Okay.
good. Thank you.
Okay. Very good.
Again.
So reverse mortgages. Should we talk about reverse mortgages?
Yeah, well, you brought it up. We might as well. I think this is within the realm of what we're discussing, which is alternative lending, mortgages for the rest of us, including seniors, people
Yes.
who, and maybe you can explain why seniors may have a hard time even getting a mortgage, perhaps. I mean,
Sure.
yeah.
Well, banks are income lenders. Okay. Generally speaking, they want to see income. And so oftentimes you have seniors who, their income is reduced because they're no longer working. They may have equity in a property, and but they don't have the income to service the debt. So the reverse mortgage is an option for them. And the reverse mortgage is basically a mortgage where you don't have to make payments. The interest accrues. You do have to, of course, pay the property taxes and the insurance, but the interest accrues. How much money can you get on a reverse mortgage depends on two factors: your age and the value of the property. So you have to be at least 55 years of age, and the older you are, the more money you can get out of the house. So if you're 55 years old, you're not going to be able to get that much money on a reverse mortgage, because don't forget, the lender is thinking, okay, interest, like this person could be, like people are living to 100 years of age now.
That's the highest, the fastest growing demographic are centenarians.
Exactly.
Literally, like I remember reading that recently.
That's right. So if you lend somebody money when they're 65 years, 55, and they don't have to make a payment for literally 45 years, you're not going to loan them that much, right? So maybe like 25% of the property value max, right? So you got $1 million house. I'm going to give you a reverse mortgage for, let's say, 2 or 250.
May I interrupt you for 1 minute?
Yeah, go ahead,
David. Just because, again, we're using the term, and I just want to make people understand that really what you're doing is you are accessing, with a reverse mortgage, you are accessing the equity in your home. Because a lot of people, especially our seniors, a lot of Canadian wealth is concentrated in home equity, and a lot of people are property rich, cash poor, and we know that pensions are not very generous, and depending on the length of time that you work. My mom retired from a 10-year corporate job. I mean, my parents were immigrants, came to Canada in their early 40s, so they didn't have a full career in Canada, but they had a significant length of time. My mom worked for a big corporation, and yet, after 10 years, her corporate pension is meager. And similarly, her, CPP, also nothing to write home about. Okay, so we have seniors that are in a situation where they really could use more money for their living expenses. Not to mention that you may be getting into long-term care health type situations. We have insurance-based solutions for that, which perhaps I'll address in another call. I mean, it'd be good for people to know. Actually, we did have I had a webinar about that earlier on. But I think this is an amazing opportunity for seniors to be able to supplement their retirement income using their biggest assets. Okay, now I'm sure people may have some concerns about that. Obviously you're going to leave maybe less, because a lot of people think, well, I'm going to leave my family home to my kids. Okay. I guess at what cost? And are you willing to leave like this meager existence so that you can make your children rich?
Right, exactly. Right.
Maybe, I'm sure you come across those types of objections, David. Maybe you could talk a little bit about that, like some of the concerns people may have. No, Anthony,
sure.
No, maybe not. No, Anthony, no, Anthony, this is a business webinar. Pero fumos, mommy. It's not just for fun. Pero fumos, okay? I love you. Pero fumos. No, maybe no.
So, you have, as you said, you have people, they want to stay in their homes and they want to enjoy a certain quality of life. Now,
Anthony, please.
Sometimes people will take money out to help their kids, right? Maybe you want to, because real estate's so expensive, you can help your kids buy their first home. It's not easy to save $200,000, right? Like the average price of a home in Toronto is probably, I don't know, still around $1 million, right?
Yeah.
So so it's not easy for people to save that money. This is also a way that parents, seniors can help their kids get into a house. You can take and if you've worked your whole life, you want to be able to enjoy. You might want to travel. Your house may need repairs. You may need money to make certain improvements. Maybe you need to make your house more accessible so that you can, or you may need money for nursing care. Different things come up, and especially now, people are not that eager with COVID. They're not that eager to move into retirement homes. They want to stay put.
No, so, David, I'm glad that you're speaking about this. I actually think, sorry for interrupting, like I'm a big fan of this product, and I think it's like a best kept secret. A lot of people don't know that this option exists because there are literally only 2 companies that are even offering this in the Canadian marketplace.
That's right.
And it's not the bank, it's not your A lender. So if you're walking into the bank thinking that you're going to access this type of plan, not going to happen. You have to go through someone like David. Right. And I think it's absolutely amazing because it's allowing seniors to access. So again, a lot of seniors out there, and again, I almost wish we had a whole session about reverse mortgages in general, and maybe we should in the future.
Sure.
But a lot of seniors have the idea that, I'm going to leave my house to my kids. Well, again, what's happening is people are living longer and longer. You may have, as a senior, you may be facing your own health challenges that you may need to access capital for because, again, let's face it, so much of Canadians' wealth is in their home equity. And then in addition to that, you're seeing your millennial children not be able to buy a property because property prices have gone through the roof. Anthony, please. Yeah. And you're saying, well, yeah, I might give you, if you're a senior in your 60s and your life expectancy is like age 85, 87, that's what it is in Canada currently. Okay, so you're going to leave this property to your now fully grown up children when you're at that age, but yet in the meantime, they're here struggling. They're not able to buy a home because property prices are, they might be able to buy a home in not close to where you live, if that's what you want.
Right.
So I think, again, it's an opportunity for parents to help their millennial children to actually get into the real estate market. No, Anthony, please, Anthony. I'm so sorry, guys. Normally I have him with someone, but we're in transition right now. Okay. Yeah.
Yeah, no, that's all good. So, you brought up a good point. Like some people are worried, like how the equity in their property is going to erode. And I have a slide here that shows exactly this. And this is an interesting slide because it shows a scenario. If you were to buy a property, if you were to take out a reverse mortgage for $350,000, assuming you're 70 years old, And let's say the house value is $800,000. Now, we're assuming in this case 6% interest on the mortgage, but I'll tell you now, the reverse mortgage rates are like 3 to 4%,
Yeah, you can get less
much
than that.
lower.
That's a worst case scenario almost from what
Right.
I've seen, David. Yeah.
Right.
And
Well,
the older somebody is,
this example is a little bit old, like it's probably about a year old.
yeah,
So
yeah,
I should update it, but I mean, it still helps to illustrate the point, right?
yeah.
Because actually, if anything, this case would be worse because of the high interest rate. But it shows you, this example shows you that the property does not erode, the equity does not erode as quickly as people might think. Because while the mortgage is growing because you're not paying the interest and the interest is accruing, okay, we also have over time properties do increase in value.
Yep.
And so if we assume a 3% annual increase in property values,
Which is
this example
conservative.
shows what will happen to the equity in your home after 15 years of having a reverse mortgage. And what it shows you, and people should snap a photo of this picture if they want, um, and they can study it later. But the basic idea is you look at the very bottom line there, you see remaining home equity. The current home equity is at the time of taking out the reverse mortgage is 450,000, and after 15 years, it's still almost $400,000 equity. So the equity has
Hardly.
not eroded
Yeah.
because the value of the property
Centimeters.
goes up, uh, as well as, you know, to sort of compensate for the interest that's accruing. No guarantees, but you know, history has shown that property values they have proven to be a very good investment. So holding on to your house, especially if it's where you want to be, and you're comfortable in your home, and you don't want to move into a retirement home, here's an option for you. And you don't have to take out a big lump sum all at once. You can literally have your house pay you $1,000 a month,
Yeah.
$2,000, whatever you need
To
to
supplement
help you
your income.
to supplement your income.
No, I think I'm a big fan, and I'm really glad that you spoke about this, David. More people need to know that this option exists.
Right.
Because, you know, as opposed to, let's say, a home equity line of credit, which people would normally, people think, well, I might just get a home equity line of credit. Well, you need to make payments on that. That's the difference with a reverse mortgage. You don't, you know, essentially the loan gets paid off when the property gets sold eventually,
Right.
right? Or what is it, when the second homeowner passes away? What's the rule, if I may ask?
Yeah, so as long as you're alive, you can live in the house and you don't have to make any mortgage payments. That's it. So now, if you move out of the house and you move into a retirement home or nursing home, you have to deal with the mortgage. You know, you got
You're
to either
given what,
sell the
about
house
6 months,
or
I think,
something.
to
Yeah, I mean, they're not going to be down your throat immediately, and they're not really even going to know until you tell them. But the you know, the program is meant for people who are living in the house. As long as you're alive, you want to live in the house, you do not have to make. You can make mortgage payments if you want. You have the cash, you can make the payments, no problem. But you don't have to.
great.
Okay. So now
Uh,
it's just about 5 o'clock. So I don't know
yeah,
if we should you
I don't
know,
know how long
freeze
you
it
wanted
for
to
now.
touch on this.
Well, I mean, it's up to you. Like, I can either, you know, just a very high level, like the remaining part and finish it in like 3 minutes, or we could take it up
Yeah,
some other time or whatever.
I mean, it's good to know that options exist for people that are dealing. I guess the concern here are properties that are not livable, perhaps, or
Yeah,
new builds
exactly.
and new
Exactly.
builds,
So
right?
the best example,
Please
I
go ahead.
think, for an outside the box, like if you have a renovator or builder developer, okay? Let's say they find a house, you know, because in our investment group, Letitia, we used to go to, right? And I know you
Yeah,
used to attend a lot of these things.
yeah,
There are people out there, they're looking for properties that like are in poor condition
yeah.
sometimes because they can get good deals on them. right? So they bought now the bank when it comes to buying a property that is, let's say, vacant and in let's say it may even be inhabitable, right?
Yeah, yeah.
The banks look at it, they go, I'm
Nope.
not lending on that
No.
property, right? So
Yeah.
you need sometimes private money to buy it, depending on how bad the condition is.
Okay.
You need private money. You need lenders who understand what you're doing. You plan to buy the property, you know you're going to fix it up, and then you're either going to sell it or you're going to rent it out. So you need lenders who are going to understand what you're doing. Um, uh, you may need construction money, which is money that's advanced in stages. As you progress, you may be building a house from scratch. Maybe you buy a piece of land, right?
Can you
Property
tell us,
investors, go
yeah,
ahead, sir.
speaking of, and that's what's considered construction financing. So if you're doing a new build, for example, or maybe an expansion on an existing property, is that something you usually need a higher down payment for those types of loans, right? That's what I heard, David. Is it
Yes,
usually?
usually you do. I mean, technically they're insurable loans, but I don't, with small down payment, but dealing with the insurers on those things can be difficult. So, you want to deal with lenders who are experienced in construction financing. The
Mhm.
rates may be a little bit higher, but they understand what you're doing. They're not going to take weeks every time you need an advance. You finished a stage, you want a lender who's going to be able to look quickly, see that you've done a certain amount of work, release money, and then also you can get out of the loan quickly too when it's done, right? You want to be able to exit quickly. So you want a construction loan. You don't want to be locked into a
That's
5-year
open.
mortgage,
Yeah.
right? So you need a construction loan. The rate may be higher, but if it's fully open and you can complete the work in 3 months or 6 months, and then refinance
Got it.
with a bank at that point in time, or sell
Yes.
the property,
Yeah.
you can get out of the loan, right? You want to be
Beautiful.
able to move quickly.
So this
Yeah.
just for me to understand clearly, David, these construction loans are available from some of your alternative lenders. It doesn't necessarily, you don't necessarily have to go to private money, right? Is that what you're saying?
We have institutions who do
Construction
construction
financing?
loans, but not that many, right?
Okay, okay,
But we'll do both, whatever the situation warrants.
cool.
Whenever you're dealing with institutions, they demand a lot more paperwork, right? You want to see tax returns and all this kind of stuff, right? Sometimes it's a challenge for small builders. You
Yeah,
may have a number of properties going on at the same time. The bank's going, how are you going to service all this? You got to, and the builders get fed up because it's like, I need to move quickly. I want to finish this. I want to
got
sell
it.
the property, right?
Yeah.
So they don't mind sometimes going with a private
So
lender who
that's,
understands the
yeah,
business.
yeah, and that's a perfect example when private money makes a lot of sense because
Right.
especially if you're an experienced builder renovator, you have your team, you know what you're doing, you know that you can complete this renovation within a certain time frame. You're only going to use the expensive private money short term to get the work done, and then your plan is to either sell or rent the property, and yeah, you have an exit strategy in mind.
Exactly. That's the exit, right? You finish the
Mm,
property, you either refinance it or sell it. We
got
also
it.
have, investors who like to buy properties, lots of them, right? They go to the
Yeah,
bank. The bank says, oh, okay, you've maxed out at 3, you've maxed out at 5, 6, whatever the number. We're not lending you any more money. Well, the alternative lenders, they don't have these kinds of maximums. Some of them do, some of them don't. And they're willing to let people grow their portfolio. We have people who have sometimes 15, 20 properties in their portfolio, and they can grow faster. I'm not going to spend a lot of time on this, but there's programs for people who want to buy apartment buildings,
yeah,
5 units and up,
it's
right?
amazing. Yeah,
Amazingly low rates if they're CMHC insured, like
yeah,
2% mortgage rates today for
I
CMHC
heard. It's
insured.
insane.
So,
Yeah,
if you have
that's
the cash and you want to get into apartment buildings, it's a great potential niche
a
that you can get
40-year
into.
amortization. Wow. Yeah,
Exactly. And that's
amazing.
basically the presentation.
Yay, David,
Yeah,
thank you
thank you.
so much. I mean, yeah, speaking of your last slide, I remember meeting one of your investor clients who had been told by TD Bank that she was tapped out. They couldn't lend to her anymore. She already owns 12 properties, very active
Yes.
lady. And you were able to very quickly help her qualify for an additional 3 mortgages,
Yeah.
3 more
Yeah.
in a short period of time. So it's like, yeah, no, you can keep going. You're
That's right.
good. You can buy some more.
That's right.
I mean, that's the kind of success story that you're able to make happen because you have an expanded portfolio of lenders. You have access to more options in the marketplace. Um,
Yeah.
so thanks again, David. Any closing words? I think you covered a lot of good stuff. Um,
Well, Alicia, I think, Letitia, I think it's great what you're doing. I think your show is great and you're a very natural
oh, you're
interviewer.
sweet. Thank you.
So it was fun and it was enjoyable.
My pleasure.
Um,
Thank you.
and it was good to see Anthony as well. So yeah, we should give him a test and maybe he can write, Anthony's going to be, maybe will become a mortgage agent after this.
Hey, whatever he wants to do. I mean, it's a great industry, and I myself was considering getting licensed. I may still pursue that, and you and I would be in touch
Well,
about
we'd
that.
love to have you. Anybody out there who's watching this and wants to become or is thinking about becoming a mortgage agent, we have monthly meetings. I'm sorry, weekly meetings now on Mondays for our team, because now it's with the new Zoom world that we're in. People have opened up their minds in terms of how they can collaborate now, and all of a sudden it's like, wow. So you mean there's no geographic limitation, right? People can learn and do business from anywhere. So anybody wants to get into the mortgage business, or if they're with a company and they're not getting the support or training they need, let me know, because we welcome you to the team.
Yeah, and David actually has his own brokerage. That's his brand, Rock Your Mortgage, right?
Rock Your
David?
Mortgage is my brand. I'm still part of RMA, Real Mortgage Associates,
Okay.
at this point in time. But I am a broker, and I do have a team right now of 3 agents, and we're looking to grow. Not an emergency situation, but the
Oh,
opportunity is
good
there
people.
for people who want to learn and get involved. And it's we try and have a good time and help people out wherever we can.
David is awesome. And the reason, and that's one thing I forgot to mention, David is very passionate about music, and he's actually a talented musician in addition to the.
Thank you,
Oh yeah,
Letitia.
I heard you play,
We're
and he can play the
rocking the
guitar.
mortgage. We're just rocking the mortgage.
And no, but I know music is one of your passions, and that's one way that you could kind of blend your passions.
And it's a great way to balance out the day too, right? Because sometimes mortgage business, I'm sure, like other business, insurance, whatever, it's hard work, right? It can be stressful, and you need an outlet to sort of unwind at the end of a day, right?
Yes, good for you for having that. And thanks again, David, so much for joining us. Thanks everyone for watching. I just checked. I didn't see any questions, David. Of course, if anybody asks any questions later, I will make sure to tag you. And I'm happy to provide you with a copy of the video. But anyway,
Great.
bye, everybody. Thanks again for
Thanks,
watching. Have a
Letitia. All
great
the
rest of
best.
the
Bye,
week.
Anthony. Thanks,
He's
everybody,
already
for
stepped
watching.
out after.
Okay.
Okay, bye for now.
Okay. Take care. Bye, Letitia.